You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we do our very best to make investing simple. You can tell every single episode I get excited for the podcast. I just have to shout out to our producers. They have an ability to just invite the very best guests. And today we have Howard Adler, who is a co-author with Alex Pollock. Surprised Again is the name of their book. The COVID Crisis and the New Market Bubble. We'll be speaking about the interplay between the Treasury and the Fed. And his background is, front lines. At time of the Treasury. I'm going to let Howard introduce himself a bit, but first, Howard, thank you so much for spending some time with us to help us understand these things today. Thank you so much.
Oh, thank you, Andy, for having me on. It's a great pleasure to be with you today.
So before we get into the book and the COVID crisis and the interplay between the Fed and the Treasury and debt and bubbles and printing and all those things, how'd you wind up at the Treasury? Give us a little bit of your history to where, how does a person become a senior official at the United States Treasury? How does that happen?
Well, I'll tell you, I by profession, I'm a lawyer. I was general counsel and executive vice president at Riggs National Bank, and then I was a partner at Gibson, Dunn & Crutcher, a law firm for 30 years, where I was co-head of the corporate transactional department. I retired from Gibson Dunn at the end of 2017 and wanted to do some government service, and I became a friend of, through one of my friends, I met someone who was a close associate of Secretary Mnuchin. They had an opening at Treasury as Deputy Assistant Secretary for the Financial Stability Oversight Council. So I went in and talked to the senior folks at Treasury and got hired and was there for about 2 years, where I ran into my friend and former client, Alex Pollock, who was also at Treasury. And when we both left Treasury in 2021, I suggested that we write a book together, and we did.
Fantastic stuff. Let's talk first about, before we get into the COVID crash, I'd like to talk, I hate politics because it's so dividing and, people tend to start to hate each other. It's a fascinating tribal psychology that we're experiencing with division. But I think it is appropriate to talk about culture. My parents were not rich at all. My grandparents were immigrants from Germany. And my grandfather was kind of a saber bug, kind of a gold bug. And it seems to me that there might have been a time where a person says, I could go buy this newfangled luxury, whatever it might be, a new color TV or whatever, or I could save for a crisis. I could save for a rainy day. I don't think that's how people think anymore. And generally, when there's a problem nowadays, they're going to say, hey, the government, someone needs to do something about this. They never say, I should have prepared, or I guess I'm an overgrown Boy Scout. I was an Eagle Scout, this idea of being prepared. And the idea of self-sufficiency. I could never run for president, Howard, because the stuff I say to my sons and my family just would never fly on a stump speech. I say things like, stand on your own 2 feet, pull your own weight. There's no free lunch. There's nothing giving, everything earned. All those types of philosophies I teach in my house, they wouldn't get me anywhere as a Democrat or Republican. So could you talk a little bit about, at the Treasury, do they see it as their job? Here we have a terrible thing where I think government, I'm not saying they shouldn't have intervened, and certainly people needed help, but the amount of money that was put into COVID and the checks that went out and the idle loans and the paycheck protection programs, I mean, it was on a scale that was breathtaking. Could you just begin there? What was that like from a guy with his feet on the ground?
That's a great perspective. I want to add that I come from a similar background to you of yours. I grew up in a fourth floor walk-up tenement in the Bronx, and my grandparents were also immigrants from Germany, so we have that in common.
Wow.
But at Treasury, I think obviously I was in a Republican administration, and we were very much looking at the budget. But when a financial crisis hits, there's a different playbook. The playbook was really written by a 19th century British banker and central banker named Walter Bagehot, who wrote a book in the 1870s called Lombard Street. And his recipe for what to do in a financial crisis, at that time the Bank of England was the preeminent central bank in the world, was to lend freely on at high interest rates on good collateral to entities with good credit. In other words, when you have a financial crisis, and what happens in a financial crisis is that there's a dash to cash. Everyone sells everything and tries to hold cash, which is deemed to be very safe. Is to pump liquidity into the market. But the COVID crisis was a very, very different crisis than others that we faced before, like the one in 2007 and 2009, which was based upon an inflation in various bubbles in various asset classes, housing and banking assets. This was a different one. This was the first time that a health crisis had led to political action to shut down the entire economy.
Yeah.
Now think about this. We've had health crises in the past. The Black Death in the Middle Ages, there was no economy to shut down. The 1918 Asian flu, nothing shut down. People kept working and sickened and died, but businesses weren't shut down, restaurants weren't shut down, small businesses weren't shut down. People were in 2020, we were facing a situation where people had no money, they couldn't pay their bills. It was necessary to take part of Bagehot's prescription, which was simply to lend freely, to get money into the economy as quickly as possible. And we were conservative people. This was, again, a Republican administration. To get money into the economy to prevent a financial catastrophe. And the 36 programs that were implemented by the Federal Reserve and Treasury working together, they work hand in hand in a crisis. The Treasury borrows money and the Federal Reserve prints the money and bought a lot of the Treasury debt that was issued to finance the COVID crisis. It still holds it on its rather bloated and inflated balance sheet at the moment. But we got the money out, and the crisis was averted. I think Secretary Mnuchin, Jay Powell, they did a fantastic job. But then a mistake was made. At the end of 2020, Secretary Mnuchin was urging that these programs be stopped, but they weren't. They were continued by the Biden administration. And we had the $1.9 trillion American Rescue Plan in January 2021, which really had very little to do with COVID and a lot to do with traditional pork. And money kept being, you had other proposals like stopping payments on student loans that would have led to more spending and less money coming into the federal government. And these should have stopped. In the book, we talk about something called what we call the Cincinnatus principle. After the Roman general Cincinnatus, who was called from his farm to save Rome from an invasion in Roman Republic times, did it in 15 days, gave up his powers of dictatorship and went back to the farm. The crisis was over. End your intermediation. And that's what failed to happen. I think we would have had some inflation resulting from the huge increase in the monetary supply that was caused by the Fed's and Treasury's actions, but the inflation would not have been so great as it is now had these efforts ceased when there was no longer a need for them at the end of 2020.
It's a fascinating play. All finance is political finance. It's unavoidable. You mentioned the insertion of pork. When COVID hit, I think it was the best. It was the best financial year I've ever had in my life. But 2020, I felt bad because for so many it was the worst of times, and for others, certain businesses like Zoom, it's just the best of times. And I wrote a lot of put options to see how low I could buy things and get paid to do it. I picked up some of the best paper asset, equities that I picked up. And so I knew it was a sale, and I didn't know how long COVID would last. I didn't know how deep the sale would go. I have no crystal ball, whatever. I just knew that from a traditional valuation standpoint, these were bargains that were just awesome. But if you'd have told me that we were not only going to recover in the time that we did, and then we double the market in the time we did, you could have knocked me over with a feather. I never would have predicted the speed at which businesses began to thrive. But now, you mentioned, the book we're talking about is Surprised Again, the COVID crisis and the new market bubble. And you mentioned the Fed's balance sheet inflated. It's $800 billion in 2008. They changed the policy. And we had a financial crisis in 2008, not a health crisis. But the Fed, acquired powers to do things they'd never done before. And now the amount of money that was put on deposit at the Fed just ballooned. The amount of money in the reverse repo market just ballooned, essentially giving the Fed, some real control competitively to interest rates around the world. I mean, if I'm a member bank and I can put money at the Fed, that basically puts a floor on interest rates between member banks. And if I'm a money market or I'm a international bank, the Fed reverse repo program essentially competes with those rates. So can you talk a little bit about the power that whenever we have a financial crisis or we have a pandemic or whatever crisis it seems to be, can you talk about the tendency or even any examples you've have where you say, hey, we had power expansion, we gave the Treasury and mostly the Fed more power. How's that played out, and what's your opinion on that?
Well, Alex and I are both advocates of limiting the power of central banks, but of course their power has grown, as you point out. There wasn't no new statutory authority really given to the Fed. The Fed has a lot of existing statutory authority, particularly when it acts under one provision of the Federal Reserve Act in conjunction with the Treasury. When they act together, they have a great deal of statutory authority resulting from the original Federal Reserve Act. And what you saw here was a vast expansion, as you pointed out, of the Fed's balance sheet. It went from about $900 billion, which was still in 2008, to $4 trillion to finance the fiscal crisis of 2007 to 2009. And then as a result of COVID, it ballooned to a high of about $8.9 trillion. Yeah. And that's just enormous. Did you want to ask a question before?
I did, because when it went from that 800 to 900 billion level and basically doubled, we went to about 2 trillion in the first round of quantitative easing, right, under Ben Bernanke. That was the first round. The idea, they'd say, well, we're going to unwind this, or we're going to deleverage it, or we're going to, whatever vernacular they want to use. And they kept doing round after round of QE. You can see it in a timeline, as you look at how that balance sheet grew. I think it's one of the most fascinating charts. And then, right before COVID, Jerome Powell said, well, we're going to go to patience. We've tried to load our gun back up by raising rates. We've tried to put bullets back in the magazine so we have something to shoot if we need to. And even before COVID hit, about November, September-ish, they actually started to lower rates. They started to ease again. And then, of course, when COVID hit, we have this huge, just, it takes my breath away, an unspeakable spike. And now they said, well, the inflation as a result is transitory, and now they're saying it's not. They're kind of in a hard spot, aren't they? Because the debt ceiling on the Treasury side is constantly being expanded. They use saber rattling, and whoever's in power blames the other, and they use this for political grandstanding, I guess, about what we should spend money on, and they're going to shut down the government because they don't like this certain program. But I'll tell you, at some point, I look at the Fed right now, and I think, okay, they want to have full employment, they want to have price stabilization. Are those opposing? Raising rates drops one and raises the other, right? The rates don't serve both of them all the time. I think they're in a tough spot, aren't they? I mean, if now we're having layoffs and that labor market is starting to show signs of difficulty, it's getting a little rougher out there than it was. I mean, and for a while, you couldn't hire anyone. It was incredible. I mean, it was just, no one wanted to work. There were so many jobs. Now we're getting layoffs again. How does the Fed navigate this now? With the size of the balance sheet they have, now it seems any reduction in rates really does affect the inflation rate, but any raising in rates now really will affect a recessionary pressure of unemployment. What are your thoughts on their conundrum?
Well, it's a difficult dance that they have in front of them, and their tools are blunt. They're mallets rather than scalpels.
Yes.
And so they can only, they can do what they can do. They can raise rates and hope that has an impact, but they can't really delve in and do, delicate neurosurgery, if you will. You raised a great point that I want to talk about, quantitative easing. Under Bernanke, the Fed did something that it had never done before. In the 60s, when William McChesney Martin was the chair of the Fed, the administration asked him to buy Freddie and Fannie debt. And he refused because he said that it wasn't the Fed's job to prop up one sector of the economy.
Yeah.
As a result of the 2007-2009 housing crisis, Bernanke did buy not Freddie and Fannie debt, but he bought mortgage-backed securities to the tune of at the height, they owned $2.7 trillion of mortgage-backed securities, and that
let me interrupt you right there.
The housing market.
Let me interrupt right there for our listeners. Most of our listeners are very sophisticated, but I don't want them to miss the point you're making. Before this time, basically the Fed would buy treasuries. The Treasury would issue the debt. People would buy it, fill the Treasury with money. And then these institutions hold treasuries, and the Fed buys the treasuries. But you're right. In the 80s, we had long-term capital management where, maybe Greenspan hints that too big to fail. And then go back. I want you to unpause and just go right where you left off on the fact that we had not purchased private types of debt, these collateralized debt obligations, these toxic mortgages that were all bundled together. I want people to understand that huge distinction, that there was not a precedent for that. So I didn't mean to interrupt you, but I want to make sure they don't miss your point, because I think it's huge right here.
Well, it's perfect. And if there's a housing bubble, that housing bubble was created by the Fed by becoming, in effect, the largest savings and loan in the world. And to let you know how difficult it is for the Fed right now, you're right. Their balance sheet does not come down very quickly because they don't sell the securities they've bought. They're afraid of disrupting the two types of securities they own are Treasury debt, as you mentioned, and mortgage-backed securities. They're afraid that if they sold large amounts of mortgage-backed securities, they'd crash the housing market. And if they sold Treasury debt, They would have an impact on the Treasury market, which is the most liquid market in the world and necessary to fund our economy. It's the most important trading market in the world for the United States. So they're stuck with a bloated balance sheet that they can only allow to run off. And as an interesting aside, like the savings and loan in the late 80s, if the Fed were a commercial entity today, it would be bankrupt. Because most of the securities it owns are low interest rate securities and interest rates are rising, the value of those securities have gone down. And people estimate that there's about a $1.3 trillion mark-to-market loss on the Fed's balance sheet. The Fed only has capital of $42 billion. They're also running about a $60 billion operating loss that actually for 2023, it's been estimated at $100 billion. So the Fed, if it were a bank, would be bankrupt. But there's a type of magic known as government accounting, and instead of treating their operating loss as a loss and charging it against their capital, which is what you'd have to do in your business, Andy, the Fed creates what they call a deferred asset and books their loss as an asset. Of course, that isn't an asset. So the Fed's got a real problem. It really doesn't want the public to understand that it's bankrupt as an entity. It says it doesn't matter because unlike a commercial entity, when the Fed's bankrupt, it just prints up more money to pay its obligations. But
that's not without consequence, right? That's not without consequence.
That's not without consequence. And as I've argued in a Wall Street Journal piece that I've written, when the Fed has a huge balance sheet and the national debt's at $31 trillion, demand for that debt is not going to go on forever. What happens if we face another financial crisis? How much runway does the Fed have left to expand its balance sheet and expand the national debt? The next time. Each time we face a crisis, the Fed's balance sheet gets larger. And that's a real problem for our country.
The question you asked is the big question on all of our minds is how much runway do we have? I thought your imagery with the metaphor of not having a scalpel but having a malice is wonderful. It is a blunt instrument. I thought that was great phrasing. To add to that, I also feel like there's not just an aspect of the bluntness versus the precision of a scalpel, but there's also timing. It's almost like they have to do something and there's not an immediate feedback of how it worked or didn't work. It'd be like driving your car at 100 miles an hour and then turning your steering wheel right or left and then waiting 3 months to see if the car reacted or not the way you wanted to steer it. And I think those two ideas together, that it's a very blunt instrument and that it's not a real-time instrument to see what happened and whether it was effective or not, is a real problem for those guys. So your best question is how much runway do they have left? And that goes back to my original cultural idea is the thing COVID did, I think, with a generation maybe 20 years behind mine, is we've trained ourselves to look, well, the government will solve this, they'll do something. There's smart people in those buildings somewhere that will do something to help us. What happens when they have an inability to help? And what would that look like? When you say there's a new market bubble, do you mean, well, we've had bubbles before. We've had a tech bubble in the 2000s. We had a subprime bubble. We had a little bit of a bubble pop when COVID. We certainly, if you look at like a Schiller PE, the amount of money we were paying pre-COVID for stocks based on their earnings was, it was probably in the top 5% of where that index has ever been. And now, even with the pullback we have now, when you say there's another market bubble, can you give some type of a size? Is it just another bump in the road? Oh, this one popped, we'll buy more stocks cheap. Or is the next one special? Is the next one where we're too big, we're not too big to fail, we're too big to bail?
Right. As you pointed out, in talk, nobody, surprised again, we were surprised by how low everything went right after COVID. I mean, our book has some wonderful charts which just show vertical lines downward in every market you can imagine. It's hard to remember how frightened we all were.
Mortified,
in 2020.
Yeah.
First, we were scared for our lives because of COVID, and then we were scared for our money. And what happened was a second surprise in 2022. Assets spiked. I mean, those vertical lines downward became vertical lines upward. You made money in the stocks you bought. If you bought in 2021, you were the happiest man in the world at the end of 2021 and in 2022. And no one anticipated that either. And now what we're seeing is that bubble is deflating. The housing market is deflating. Other asset prices are coming down. The Fed's actions obviously are having a part in that, but they had no choice because of the necessary actions that were taken in 2020 to stimulate the economy, and the unnecessary ones that were taken in 2021. We've got a huge inflation problem. I'm not saying that Putin's invasion of the Ukraine and supply chain problems didn't add to that inflation.
Certainly.
But the increase in the monetary supply that happened in 2020 and 2021 was the primary cause of that inflation, and now you're seeing the air come out of that, and what you'll have then is some sort of a return to normal. Interest rates will eventually come down again, and there'll be new bubbles and new deflations in the future, just as there have been for the past couple hundred years.
I look at, for our listeners, I look at the idea of inflationary force and deflationary force as two large arms wrestling. They're opposing forces. They're not periods in time chronologically where we said, well, we had inflation here and deflation here. It's really an arm wrestle. The thing of it is the arms are getting big. There's a lot of steroids in both of these going back and forth. And with the blend instrument, as you mentioned, if one arm breaks, we can have a huge impact. It seems that someone like Alan Greenspan looked at the Great Depression and saying, that was preventable. We could have, John Maynard Keynes would have done it differently. Austerity is not the answer. We really do need the liquidity. We need to keep this going. And so it seems like at all costs, depression, unemployment, a strong dollar, that's not an option. On the other extreme, you have Weimar republics and all the scary stories of, and I don't think those are, Zimbabwe, those are a little extreme because, Zimbabwe had a crazy dictator and that was kind of nutty. But I do wonder about the future of our US dollar in terms of the world reserve currency. With digital currency becoming more popular and the way some people think money's changing, if the U.S. Treasury, I guess the modern monetary theory folks say, well, as long as we can tax, we can create a man for a dollar, right? If we say we won't accept bitcoins or gold or anything else, you have to have dollars. I guess that could create a demand by law for a U.S. dollar. But what is your thought on the future of the dollar if everyone else in the world that doesn't have to pay taxes no longer decides, hey, 1971, Bretton Woods is kind of over now. Is there a chance we unwind and get away from the U.S. dollar globally? Or is that position threatened of the world reserve currency?
What a great question, and we deal with that in our book. Right now we have $31 trillion of national debt, and what's scary is that $5.7 trillion or so of that is held by the Fed. That's a very large position in debt. How much demand is there for that debt, for Treasury debt worldwide? As you point out, we are the world reserve currency, and what that means is that most foreign central banks hold most of their reserves in U.S. currency, and it's in the form of Treasury debt. That creates huge demand for Treasury debt. But that demand is not infinite. There are only 8 trillion people in the world, I guess. And that's finite. And moreover, you have a lot of pushes. I love your analogy about the two steroid arms, your metaphor. I think it's brilliant. You have a lot of pushback now against the dollar that you've never had before, and that comes from a variety of sources. The Chinese are pushing the yuan. There are a lot of people in the world who fear United States sanctions. We've weaponized the dollar, and people who use dollars are subject to those sanctions. So you have countries that are hostile to us like Iran, Russia, China, Venezuela, North Korea that are looking for an alternative to the dollar so they won't be subject to sanctions. You also have the Chinese having enormous influence over developing nations through their Belt and Road program, where these nations owe the Chinese so much money that the Chinese can, in fact, have a lot of power to dictate what goes on in their economy. And if they want to use the yuan, you read in the paper that Saudi Arabia is now going to accept the yuan for purchases of petroleum. That's huge. All of that erodes the power of the United States dollar, which in recent years, 80% of international transactions have been done in dollars. If that erodes, then the demand for Treasury debt stops, and the interest rate on that debt will have to go up. Our economy has been subsidized by the fact that the dollar is the world reserve currency. You also, because we get to borrow at a lower rate. You also mentioned digital currencies, and that's huge because one of the next battlefield for central bank power is going to be in the so-called central bank digital currencies. The U.S. is looking at a digital dollar. The Chinese are far advanced with a digital yuan. The progressives say that this is all great because it will allow the 1.7 trillion unbanked people in the world to be banked, and it will facilitate time-consuming and costly international transfers of funds, but it will add enormous power to the Fed. What happens if we have a federal digital dollar?
Well, your privacy's gone. Your privacy's gone. They'll track every. Their privacy's gone. They will collect taxes, though. No more cash under the table, right?
Right, but they'll be able, as you point out, they'll be able to see every financial transaction in the United States. There'll be deposits booked on the Fed's balance sheet, so that balance sheet will remain forever bloated. You'll have to have assets to offset that deposits. That raises the possibility that a Fed could, credit allocation, that a Fed could favor politically favored industries and cut off credit to others that aren't. And all of that is very, very scary. It could also, at its most extreme, destroy the private banking sector in the United States, and all of your banking transactions will be through the Fed in the form of Big Brother. That works for China, where the Chinese want control over their domestic population. And they also wanted to set up the digital yuan as a competitor for the dollar. But when it comes to a free country like the United States, giving the government that much power is a very scary prospect.
Well, you better believe it. So many great angles in this conversation. When you look at a bubble and the bubble begins to grow, there's often a catalyst that helps it pop, whatever it might be. We could go back and, when Lehman Brothers and Bear Stearns kind of broke, that triggered the subprime meltdown. And there was a domino effect that had to be stopped by the Fed there. When Rudy Gobert and the Utah Jazz got pulled off the floor with COVID, the next day the NCAA tournament was canceled, and, it just triggers types of things. So there's liquidity issues that can trigger these. I think one of the interesting ones, if you comment on this, is if you're listening and you're new, when you look at the Federal Reserve's balance sheet, you could really look at their liability column with 4 accounts. You'd have currency in circulation, which is growing, and as they print money, it tends to leak into there, I think. The second account you have is the money they owe member banks. If I'm Goldman Sachs and I put deposits on at the Fed as a savings, well, they owe me that money, right? It's a liability to them. The third account is, I believe, and you could confirm this, is they kind of take care of the checkbook of the Treasury. When the Treasury sells bonds and they have cash, the Fed holds that money, and you can see that shrink and expand as they borrow and spend and borrow and spend and borrow and spend. It expands and shrinks. I think one of the most interesting parts of the Fed liability column is the reverse repo market. I think it's fascinating, and the reason I think that's so fascinating is one of the things I think could really be a pin that could pop one of these bubbles is the money market if they break the buck. A lot of people take this for granted, and I like your comments on it. If I'm a stock trader, which I'm not so much a trader as an investor, but stock traders go from money market to equity to money market as they buy and sell. And when they sell a stock and that money, where they liquidate that stock, now they have liquid cash, generally that's put in a money market. Savings are long-term. That money needs to be loaned out in housing, in banks. But money markets need investment. They need a place where that dollar will still be a dollar tomorrow, and yet they can still make a buck on it. And generally that comes from three sources. Treasuries that can be short-term, and they're considered risk-free. Commercial paper that is, really, you loan money to Apple short-term, you'll probably get it back. And the reverse repo market, the repo market. And I think to myself, with the expansion of the repo market, as huge as it is, I mean, it's gone from almost nothing to hundreds of billions. Where do money markets go if that falters? I mean, there's a dependence, I think, now from the money market community, that sector, on reverse repo. And if they break the buck, it's like Tether and Bitcoin, right? Everyone has, I think it's a funny parallel. Everyone talks about Bitcoin as being open ledger, right? Audited ledger, non-centralized. And yet when they trade it, they go to Tether, which is totally centralized, not audited, and not open ledger. And so the idea of having a place like Tether that's supposed to be stablecoin, or a place like money markets that's supposed to be stable, could you talk about the counterparty risk that money markets have in doing business with the Fed as reverse repo?
Right. The reverse repo market is also a trading market for treasuries because the collateral on most of those reverse repos are treasuries.
Yes.
And that's the way treasuries are generally traded in the market, through the reverse repo market. In 2020, money market funds came under a lot of pressure. Money market funds are like banks without FDIC insurance.
Right.
It works very well if only a few people want their money back at a given time. But if everyone wants their money back, money market funds can't provide that.
No liquidity.
And the reason they can't provide that is because liquidity is ephemeral. What seemed like a liquid asset in good times is not a liquid asset in bad times. Mm-hmm. Asset prices plummet, and you can't sell that. And often there is in 2020, all of those markets dried up. And money markets are susceptible to runs. And you see the SEC kind of blundering around trying to regulate them and make them safer by having by saying you can't have for some funds you can't have you've got to have a market, you can't have a buck of value, you've got to have market value, or you have to have at some point there are gates that bar your ability to redeem. None of that. The gates didn't work at all, it turned out. It just meant that as people got closer to a gate, folks were more inclined to try to get their money out and be first out of the gate and first to get their money. And none of that really works because of the economics of money market funds, which is that they only work if everybody doesn't want their money back at the same time. So I think that's going to be, in times of crisis, going forward, there's always going to be pressure on these money market funds, and they're not going to be as safe as people think they are, because they really aren't as safe as people think they are. They're not as safe as bank deposits because they're not backed by the federal government. And I'm not an advocate of putting in more federal guarantees for other sectors of the market. I'm a free market kind of guy. But people have a mischaracterization of the safety of money market funds. They're safe in most times, but if you've got a liquidity crisis, they are not. Their safety level goes way down.
There seems to be, with Fed intervention, particularly with rates, there's an intervention with the supply and demand of, perhaps, let's start with the real estate market. Obviously, the higher the rate goes at the Fed, the more I'm going to charge for a higher risk of loaning money. If I can deposit it at the Fed at 6, I got to charge more than 6 if I loan it to an individual that has risk. And so there can be a bit of a detachment, I think, from the fundamentals of the real estate market, in that, why did we have a bubble in 2008? Well, zero, if you have a zero down stated income, no doc loan program, everyone can buy a house. In other words, credit empowers purchasing. It increases demand because people are empowered, and there can be a detachment from the fundamentals. Well, okay, we have a housing problem. Fed steps in, starts buying mortgage-backed securities, bailout. Okay, great. We have a pandemic problem with jobs in the labor market. Fed steps in, paycheck protection. If the Fed were to, and Janet Yellen, I've heard, has talked about this. Okay, so if the Fed looks at 401ks, which are tied basically to equities, a little bit of debt, but mostly equities, and we decide that a major crash like this, or a bubble that's big enough that starts destroying people's retirement. In other words, just as many people depend on a job during COVID, a lot of people depend on a 401k when they no longer have the job. So there's an incentive for the government to step in. What if they start buying equities? The detachment that would happen between the fundamentals. I mean, you could buy, the Fed could bail out GameStop or something, right? Do you have any thoughts? And is there any, being there at the Treasury, what are the conversations you were perhaps privy to between your interaction at the Treasury and the Fed and those officials about including equities? You mentioned earlier it was a major shift when the Fed went from just government treasuries to private, mortgage-backed securities. Is there talk of them expanding power to save an equity market by propping up equities simply by buying things based on price rather than fundamentals?
Well, fortunately, no. That would really be very scary. It would inject politics into the financial markets to the extent that they've never been injected before. I mean, you can imagine, for example, this administration would be buying up green stocks and shorting traditional energy stocks, and that's really a scary prospect. By the way, just going back, the Fed did bail out. They did have a line open for money market funds during 2020.
They would have broken the buck.
That's right. They would have broken the buck, but the people didn't really have to. The fact that the line was it was just in effect did a lot to restore confidence. And what you're talking about in pension plans is exactly right. Look what President Biden did in the American Rescue Plan. He bailed out this multi-employer union pension plan system to the tune of about, I think, $86 billion, at least under the Congressional Budget Office estimates. It may be much higher because it isn't capped. One of the things we talk about in the books is a huge underfunding of public employee pension plans at the state and local level throughout this country, and how that could potentially be the largest bailout in history if you ever got a very, very progressive administration. We talk about the example of Illinois in particular, which is the worst underfunded pension plans in the country. So that's sort of on the table. But I have not heard, fortunately, inclination of anybody to go in and at the individual level and bail out 401ks. But if you're, in a very progressive administration where the view is the government does everything, and people are rightly concerned about retirement income. I think that, who knows if that isn't an unpleasant surprise waiting for us in the future.
Well, the reason I bring it up is there was an article in Reuters that talked about Janet Yellen. And that's a really interesting transition to be, Fed and Treasury. I mean, she's an interesting individual, but she says, quote, "It could be useful to be able to intervene directly in assets where the prices have a more direct link to spending decisions," unquote. She said, adding that buying equities and corporate bonds would have costs and benefits. So I was like, wow, to me, that would be disastrous for the very reasons you stated. All of these, let's talking more generally. I'm not a very smart guy. I'm the luckiest guy in the world because, the podcast for me, having done, a few, I don't know how many episodes we're on, but I get to talk to guys on the front lines like you. I get to talk to people, and a person who, my formal education, I would never get to law school. Let's just put it that way. An LSAT for me would be a death nail. Okay. That's a non-starter right there, taking just an LSAT for me. But I get to talk to you guys and I learn so much. And I just feel that the reason I get excited about the podcast is in my general circles outside of business. I don't get to talk about these things with people because I don't think it's in their purview. The reason I like having guys like you on so people can go pick up a copy of Surprised Again, the COVID crisis and the new market bubble, merely to help an electorate or a citizenship become perhaps more literate in these types of conversations where they can at least participate and understand some of the jargon, some of the nomenclature where, like if you and I remember the jaywalking with Jay Leno, where he'd go out and ask simple questions like, who's the vice president, right? And people had no idea. Can you imagine if you and I went out jaywalking with a mic and went up to a bunch of citizens and said, "So what do you know about quantitative easing?" And see what they have to say. Or, what does it mean if the Fed says we're going to expand our balance sheet? Can you decode what they mean by that? Could you speak to the general status of financial education and awareness in our citizenship, either in the United States or globally? What's your take on that?
Well,
probably why you wrote the book.
Well, that's a great thought. But you're absolutely right. The level of financial literacy in the economy, I think, is relatively low. The best advice anybody ever gave me in law school, I remember taking corporate finance because I knew I wanted to be a corporate lawyer. And the first thing the professor said was, subscribe to the Wall Street Journal and read it every day. There's an enormous amount of education out there. If you read the journal, just the journal, forget about, other good magazines like Kiplinger's or, the Financial Times, but just the journal, you get a very, very good financial education, and at a relatively easily understandable level. But it is not. I do not think that most people in the crosswalk would be able to explain quantitative easing or have any idea about what impact the Fed's balance sheet has on the economy, and by the way, on their own lives.
Yes.
But that's what podcasts like you and like what you said, remind me of almost, when I'm practicing law and I'd sit down in some deal next to some guy who said, "Well, I'm just a country lawyer." I always was very, my antenna went up because I knew this was probably some very, very smart guy who was just being modest. And that's the case with you, Andy. Because you obviously are a very sophisticated and bright guy and understand these issues. But I don't really know what you do about that. Maybe you have people in high school have to take some schools are doing this, I understand, a financial literacy course just so they can navigate through their own financial lives. know how to deal with their own 401ks and their own investments.
I heard a statistic, it might be apocryphal, I don't know, but I came across the statistic says that those who do have financial lit programs in high school, 80% of the kids can't pass it. Basic financial lit. And we're talking just balancing a budget. The difference between an asset and a liability, an income statement and a balance sheet, a statement of cash flows for the average person, it's almost non-existent. Let's talk about practicality for a minute. So we've covered some incredible ground. I have to thank you. I always ask the guests so the listeners know, how much time do you have scheduled? And Howard said, Andy, I'll give you whatever time you would like. So we're grateful to take advantage of that, because you don't get to talk to people who were, who's senior officials at the U.S. Treasury very often. Let's talk about practicality. In the Black Plague, or even in the Great Depression, I'm old enough, I'm in my 50s, and I'm old enough to remember, shelling peas and snipping beans and working in the garden. And, my neighbor had Bessie the cow, and there were chickens around. I mean, we've changed. We can't be as prepared. Maybe the best thing to do is go join an Amish community. I don't know. I mean, those guys won't even know anything happened. The idea of self-sufficiency as opposed to communal dependence is a huge philosophy right now, not just politically. And I'm going to hopefully not get too opinionated, but as I look at the trend towards victimhood and the claims of inequality, no one argues that. No one argues that we've all been a victim of something, and some worse than others, and there's just no inequality. I mean, everyone is just by the lottery of parents. You have parental roulette, that when you're born, who's your dad is a huge deal. But I believe this, and I'd like you to talk about the practicality of this knowledge. I believe that there is no government program that has the horsepower to overcome a poor individual policy. And yet I also believe, perhaps naively, that there's also no government program that could take down a powerful individual policy, a personal monetary policy, one of individual preparation. If we have surprised again the COVID crisis and a new market bubble, in my opinion, based on where I sit, looking at the size of two balance sheets, the Fed balance sheet, which is topped out about $9 trillion, the Treasury balance sheet, or I guess you'd say the CBO could look at this, and the Government Accountability Office could look at this, the GAO, Comptroller General of the United States, would say, yeah, we're $30 trillion in debt that's been monetized, but we're also in unfunded debt, stuff we owe, obligations. We're probably north of $100 trillion to keep the entitlement programs that we've promised. So we have hundreds of trillions of dollars in a $20 to $30 trillion economy, GDP. What does a person do individually to practically prepare? If you were speaking to, one of your children or a nephew, and maybe he's 20, and you say, let me tell you, this is how you prepare if the dollar's no longer the world's currency, or if we go digital, or if all of a sudden treasuries, there's no liquidity, or if we break the buck in a money market. I mean, what is the practical advice you would give a nephew or a son or a daughter if we have a new market bubble of this magnitude that finally bursts in a big way? Long question, but I think a good one.
Yeah, I think it's a good question too, and it goes to one of the themes of our book, uncertainty. One of our themes is that we are the condition of humankind is to live in uncertainty. We don't know whether we're going to live another 50 years or whether we're going to be hit by a bus when we cross the street tomorrow, and that's specific. Certainly, even it's very true in financial matters. There's often an enormous amount of uncertainty. So I think what I would urge somebody is to avoid trends and to basically asset balancing. I mean, cash isn't particularly safe. We live in an environment where the Fed is shooting towards 2% inflation, which means the value of your cash is going to diminish every year unless you can invest it in something that beats inflation. Markets are uncertain, but I think you can't stay out of the market. I think a balance between equities, debt, and cash, a prudent balance, is the only way you can go, because there is nothing that is safe and secure. Any market that you're in is subject to change, and cash is only as good as the full faith and credit of the United States. So there is no, if you want to be self-sufficient, you have to be smart, but you are facing uncertainty across every asset class, and the best thing you can do is try to attain a prudent balance, so that if one or two sectors go up, now that of course doesn't help you in an environment like we've been facing for the last year, where both equities and bonds have been going down, and the inflation has eaten away at your cash. There is no safe harbor, but I think as the asset managers always tell you, balancing of assets, and if you're conservative towards a more conservative level, is probably the best you can do as far as self-sufficiency goes. I'm not advising people move to the mountains and grow their own, and live in a bunker and grow their own food.
Of course, some days, my wife and I look at each other and say, "Do you feel like moving to the forest?" So there's some days that'd be a tempting venture. I would add to that, guys, practically, if I was speaking, what I do teach my sons is I say, be a producer, not a consumer in the world. Because when things get tight, people are even more needy. If you believe in a 2% inflation target, if you think they can hit it, debt in real estate is a fantastic investment, because you're essentially short in the US dollar. If you believe, in short positions, I think those are really scary in the equities market. But I think as the dollar is concerned, if I can borrow when the dollar is strong, and I can trade it for something that people need, I can be a producer of housing. And over 30 years, I believe that you're going to have 2% inflation on that dollar. I'm giving that dollar back where it's worth less. And I think being a producer, not a consumer, understanding equities, understanding debt, understanding the proper use and smart use of leverage that is collateralized and also produces cash flow, it's a huge thing. Bottom line is, knowledge is life. And when things are uncertain, having knowledge from a book like Surprised Again, the COVID crisis and the new market bubble, it changes your life. Having done, however many 100 podcasts we've done, and had a chance to review so many books and speak directly to these authors, I think it's blessed my life tremendously. And I'm just so happy to bring you this opportunity here from Howard Adler, the author of Surprised Again, co-author of Surprised Again with his co-author Alex Pollock. Surprised Again, the COVID crisis and the new market bubble. Pick it up at Amazon.com. Would you be willing to come back when it pops and talk to us a little bit when these things play out?
Sure, you'll have to find me in the forest, but assuming I've got cell phone reception, I'm good.
Well, I'll find you. I know your antenna's up because you're talking to those country lawyers, so we'll be able to find you. Your antenna will be up. Thank you so much. Hang on after I close so I can properly thank you. You've been listening to the Cash Flow Academy show. I'm your host, Andy Tanner. This is where we do our best with complicated stuff to try to make it simple for you. We encourage you always to pursue your education. Knowledge is life in this environment. Learn to be a producer, not a consumer. Pick up a copy of Surprised Again, the COVID crisis and the new market bubble, and we'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.